Hey everybody, this is Ted Bauman here. I've been away for a while. I was traveling. I was back at my home in Cape Town. I'm back. I have been very busy. And as promised, here is the next installment of my video series for you. Now, the big thing that everybody's been asking me about is what is likely to happen to the stock market going forward in the next couple of years, next 10 years. And unfortunately, the message is not a good one. And let me explain my rationale. Now, before we do that, let's just look at the underlying drivers of bull markets. In other words, what is it that makes stocks grow? Well, one of the reasons that you get strong real returns is when the market hits a bottom and it recovers from that. In fact, I saw an article the other day that said almost all the other gains that you make in the stock market come from buying at the bottom and riding it back up again. Buying at the top and just waiting for stocks to increase in value over time doesn't get you much more than the long-term average rate of return, which I'm going to talk about in a moment. But what are the things that drive real returns in the stock market? Well, the first one is valuation expansion. Basically, people willing to pay more for a dollar of earnings than they were before. And that bids up the price of those earnings. That's what we always see in bull markets. The second thing, of course, is growth in earnings. When companies are growing their earnings, just mathematically, even if the price to earnings ratios remain the same, higher earnings means higher stock price growth. So that's the second part of it. The third part, of course, is falling interest rates. When interest rates are low, that typically means that inflation is also low, which is bullish for stocks. But it also means that the future earnings of companies are worth more in present terms using discounting, which is something I've talked about in the past. But basically, when interest rates are low, future earnings are worth more today than they would be if interest rates are high. So when interest rates are falling, you can expect stocks to go up. Now, here's a chart that shows long-term valuations and long-term returns in the stock market. Now, I would say that the long-term average stock market valuation was probably somewhere around 20 up until um, probably the beginning of the 1990s. And at that point, we saw a steep takeoff in basically the Cape valuations rising to 44.2 at the peak of the dot-com bubble. Now, the important thing for that is that that means that the long-term typical market supported rate of valuation is about 20. So in other words, people will pay about $20 for a dollar of earnings. On occasion, that has risen, and it rose to extraordinary heights during the dot-com period, also just before the great market crashes of 1870 and 1929. But we also saw a historically high rate of cyclically adjusted price to earnings ratios in the aftermath of COVID. So from 2019 to 2021, that spike you see, but now we're starting to pull back. My point is that we're still fairly high. We're at 27.72 on this chart, which is a little bit dated, but we're still pretty close to that. That means if we fall back to the historical sort of rate of, what people are willing to pay for a dollar's worth of earnings, we could still fall quite a bit. So there is still the possibility of a secular bear market continuing. That upper right-hand corner where you see that just the beginning of that right turn, I predict that we're going to see that continuing. And unfortunately, that means that the market still probably has a ways to go. Now, the reason for this is pretty simple, and this is where I base my predictions for the next decade on. Here's a chart that shows the forward 10-year returns that have been enjoyed by investors based on different levels of cyclically adjusted price to earnings valuations. Now, we are in that red box. That means that historically, whenever prices or stock prices have been valued between 25 and 30, right about where we are, future valuations have varied between 0 and about 5 to 6%. So that means that at our current levels of valuation, we are unlikely to see a decade, 10-year returns in excess of about 5 to 6% per annum, which is lower than the longest or than the long-term average of 8. And that's because stocks are basically overvalued. If we were undervalued, we could expect to see very high returns if we were moving to the left, but that won't happen for a couple of years until the stock market loses some of its valuation. Now, that doesn't mean that every year of the next decade is going to have low returns. It just means that the total return over the next decade will be low. There could be exceptional years. There could be years to the downside as well. Now, here's a chart that shows that, again, it shows that the cyclically adjusted PE ratio tends to have a fairly strong relationship to the stock market. But when the black line, i.e. the real price of the S&P 500, gets excessive relative to PE ratios, that means that it's likely to fall. In other words, when that black line is above the blue line, and that blue line starts to fall, it's another way of saying that we're looking at declining prices. Now, for stocks, the other way to look at it is to look at those dotted lines, which are the exponential, smoothing trend lines of the two. Basically, the real price of the S&P 500 has simply got out of whack with cyclically adjusted PE ratios, and we're due for a return to the norm. Now, over the very long term, stocks have returned about 6% from capital appreciation every year and about 4% from dividends. I love dividends. But remember, we've had an average inflation rate over the last 100 years or so of about 2.3%, which means that if you get a return of around 8% annually, you're actually doing well in terms of the long-term trend. What I'm predicting, though, is a return between, say, 4 and 6%, which is still going to be below the long-term levels, simply because we have to bring valuations back into line. And if we have falling earnings at the same time, then that's going to put another drag onto stocks. Now, here's another way of looking at that. Here's the average annual real return of the S&P over different periods. And the critical thing here is that since 2009, since the great financial crisis, no matter how you slice it and dice it, whether it's 2009 to 21, to 2012 to 21, or 2017 to 21, the average annual real return has been way out of whack with the long term. And as you can see, the long term is between, say, 8 and 9.25%, depending on the different ways that you define this. But basically, what that means is that the last decade, the last really going on to almost 15 years now, has simply been exceptional, and we cannot expect that to continue. Now, why did this happen? Well, we've talked about this in the past. I've talked about it many times. Basically, it was all about massive monetary interventions designed to kind of prop up the economy and keep it going, particularly after the great financial crisis. Now, remember, in the initial recovery from the great financial crisis of 2008 and 9, Congress agreed to a stimulus package, but it was a very small one, for example, relative to what we saw during COVID. And that meant that the Fed really had to step in and use low interest rates to try to compensate for inadequate government spending to get us out of the economic hole we were in. That led to a situation where the financial support that the Fed was trying to give to the economy actually bled over into asset markets. And that led to excessive valuations growing over the last 10 to 12, 13 years. That meant that the whole stock market became really one giant leveraged long duration trade against future earnings. Because remember, low interest rates mean future earnings are more valued. And that is really what drove it all. Now, there were some growth in profits and earnings in some specific sectors of the economy, but the overall driver of the stock market has been the Fed for a long, long time. Now, we all know that, but the important thing to recognize is that now that that is reversing, that's going to be one major headwind, putting stocks back down towards their long-term, their long-term average. Now, there are other headwinds as well. One of them is that here's a chart that shows that the elderly population is growing rapidly while the working age population is falling. That means two things. One is that people who are retiring tend to pull their money out of the stock market to meet their retirement income needs, and that leads to lower liquidity in the market and falling prices. The other thing that happens is that they cut back on their own spending because they have to live on a budget that comes from their retirement savings, which means that companies' earnings go down. So this is what we've seen in Japan, for example, as the population has aged and the working age population has fallen. Its stock markets have simply stagnated. In fact, the whole economy has stagnated really since the 1980s. And a big part of that is this demographic trend, which we are about to face. Again, that's another reason why we would expect to see profit margins and earnings fall to levels that align with actual economic activity. Now, here's another way of looking at it, that as we've talked about elderly people pulling money out of the market, reducing liquidity. But there's also the fact that we need to bring, again, real profits back into line with the actual level of the S&P 500. Whenever you see the that blue line, that blue segment above the black line, that means that real profits are not growing as fast as the stock market is growing. So again, as elderly people cut back their spending, as the rate of population growth slows, as immigration falls, because everybody appears to be against immigration, just like in Japan, you can expect the stock market to fall back as a result of that. Then, of course, there's the question of debt. Here's a chart that shows the leverage in the system from pretty much all sectors: government, corporate, household, stock market, trading, margins, accounts, student loans, etc. Basically, debt began to pull away from real gross domestic product in the late 80s. And it rose significantly until the great financial crisis, pulled back a little bit. And then once the Fed started pumping money into the economy at low interest rates, it just took off. The important thing is that as interest rates rise, as corporate profits fall, that black line has got to fall as well. That means that money has to get paid back as opposed to spent on investment or anything else, which means, again, that the real economic impulse under stock market pricing is fading away, because not only interest rates high, but people are scrambling to pay off debts before those interest rates begin to become punitive. Now, we've already seen a lot of this happening, as you know. I mean, if you've been holding stocks in the market, you've seen during 2021 just a collapse in overvalued stocks, things like the ARK Innovation Trust, the Cathie Woods ETFs, absolutely slaughtered, down almost 70% from its peak. And all of that, of course, is because interest rates are the only reason that those stocks really went up as high as they did. They may be great long-term companies, but not right now. But here's just a chart that shows you what has happened to stocks that got too expensive during the last decade. Basically, the contribution to losses in the world's stock market indexes, all cumulatively, are clearly heavily weighted towards the most expensive stocks. So the more expensive the stocks are on PE, in PE terms, the more their losses have weighed on the stock market. By contrast, cheap stocks, value stocks, dividend-paying stocks that are fairly priced relative to their economic activity and their economic positions, are doing reasonably well. And that's why I pulled into those big time last year, why all my investments during 2022 were really oriented towards dividends, and why I beat the market significantly in my own portfolio. Here's a chart that shows something similar. This just narrows it down to the big guys, the Apples, the Microsofts, the Alphabets, Tesla, Meta, etc. We can see that really their contribution to the growth of the stock market as a whole in the United States began to pull away in the mid-teens. And right up until 2018, they were basically driving the growth in the stock market. During 2018, Chairman Powell began to make noises about raising interest rates again, but then he blinked in December of that year. And from the beginning of December 19, the stock market went on a tear. It began to turn actually before the COVID crisis, but the COVID crisis is what pulled it back. And then you can see a sharp uptick in those stocks as monetary policy, basically the flood of liquidity during 2021. But now look what's happening. We're seeing an equal and opposite reaction coming from these big long-term leveraged companies. And the reason for that is because people are no longer willing to overpay for their future earnings. So the basic message here is that the stock market moved far away from its long-term mean return, and that was due to intervention by the Fed. We are not going to see that kind of intervention. In fact, we're seeing the opposite. It's having the effect that everybody expects. Stocks will continue to revert to the mean, but in order to do that, they'll have to dip below the mean, which is why, for example, this year we're probably, in 2022, we saw almost a year-long bear market, just less than 20%. This year, I predict we're probably going to see returns in the 4 to 6% range if we're lucky. But everything depends on whether or not the government begins to pump more money into the economy to compensate for the Fed withdrawing its liquidity and its low interest rates. But you just saw what's happening in Congress. They could barely elect a speaker. It's highly likely that there will be some serious problems in the next year or two during this current Congress as the far right-wing members of the Republican Party, those who didn't want to vote for the new speaker begin to demand concessions in the form of not raising debt ceilings and various other things, which could have a catastrophic effect on the global financial system if the Congress refuses to allow the Treasury Department to pay interest on its Treasury bond obligations. If that happens, it'll make the great financial crisis look like a walk in the park. The key thing is that the next 2 years are going to be exceptionally rocky. So my gut feeling is that with the Fed in anti-inflation mode and with Congress basically dysfunctional, this is going to be bearish for stocks. So again, you want to go to safety and you want to go to the dividend stocks. So next week, I will talk a bit about what kind of stocks those are. A couple of weeks ago, I talked about closed-end funds and other things. I'll take a deeper dive into that next week. Anyway, this is me signing off, and I'll talk to you soon.